Do you have a company in Latvia? Or probably you're planning to open a company in Latvia? Then the first and one of the most important questions is how to finance this company. And there are basically two ways how to do it, via equity or via loan financing. Hello, my name is Arturs Breicis. I am certified tax advisor. And in today's video, I'm going to tell you about how to finance a Latvian company, what are the main or basic legal implications and basic and more important tax implications for both ways of financing a Latvian company. Okay, let's get started. So in today's video, we will look what is the equity financing, how it is done or made, what is loan, and what are the differences for those types of financing in Latvia, and what are the tax implications for both of the types of the financing. And at the end of the video, you will learn how to what are the tax implications and what are the conclusions or recommendations how to do it in the most advantageous and most efficient way. So how to finance company, equity or loan? So if we look at this picture, you can see that here's an operating company, here's a holding company, for example, in Sweden. And the question mark is what to do, whether to issue new share capital, increase equity, or to issue a loan to operating company. In order to address this question, the most important thing which we should talk about is the Latvian corporate income tax. And the specialty of Latvian corporate income tax is that the dividends, that tax is not payable on the accounting profits or declared profits, but tax is payable only on dividends paid out of the company. And what does it mean? It means that you pay tax only when you distribute out dividends out of this operating company, and until the dividends are not distributed and profit is held in company as retained earnings, no tax is payable. So no corporate income tax on retained earnings. This is great, of course, and then which means that by increasing equity, you can save on dividend payments on tax. If you do not want to repay the invested capital and do not want to repay dividends in the coming nearest years. But it's of course has some also a downside, kind of a disadvantage, is that if you look at the loan, then in traditional corporate income tax system, the interest is deductible from the corporate income tax taxable base. Yes, but in this case, in Latvian corporate income tax rate, the interest is non-deductible, which means that interest expenses do not influence the value of the profits, the value of the corporate income tax payable. Of course, interest reduces the profit. Yes, and the profit which you can distribute as dividends reduces, but it doesn't influences the tax directly. So the interest is non-deductible, and we should bear it in mind, because in the theory the loan is considered as more tax efficient instrument of financing the company because of those deductions, because of the deductibility of interest. In case of Latvian corporate income tax, I would say that interest in this case is kind of it doesn't play any role. So that's why the financing and investment theory doesn't work here in Latvia as it should be in theory. So yes, so first thing we should to consider is this corporate income tax implications, which means that dividends are corporate income tax is payable only dividends paid, and interest is non-deductible. non-deductible, and bearing that in mind, let's move further. Let's see what the first of all, let's see what the equity financing and what the loan financing is and how it is regulated in Latvia. First of all, when we talk about equity financing, we mean share capital. The minimal share capital is 2,800 euros. Of course, that the share capital could be higher. Usually, it's recommended to be higher. And the share capital could be invested or increased either by cash payment, by monetary payment, or by in kind, meaning that the property is invested instead of cash, and this property could be also shares in the other company, so kind of share for share exchange, so called. So in case if the investment is made in cash, there is no problem at all. So you paid cash and increase the share capital. But in case of if the share capital is increased in kind, this property which are going to be contributed should be evaluated by the appraiser. So this means that you cannot just say that, for example, that you put some fixed asset which costs 1,000 euros, then you have to, of course, for small contributions you can do that, but for in most cases you have to obtain the evaluator's kind of assessment, yes, so valuation. Yes, and the share capital, of course, there is a legal procedure how to do it, which is quite straightforward. We will not go into detail here, but it's kind of straightforward and doesn't take much of the effort. Which we cannot say about the reduction of the share capital. So if you decide to, after some time, to take out the capital of the company, it involves the certain legal procedure, but of course the problem might be in case if the equity is lower, you have some losses, and equity could become negative as a result of the reduction in share capital. In this case, there are restrictions, which means that you cannot take out all the capital, and equity should stay positive after this reduction. So if we compare this loan, then the loan could be repaid in any time. Of course, if the operating company has funds to repay, but in case of the share capital, the reduction of share capital has restrictions. Of course, if the things go well and the company has profits, then the reduction of share capital also is not very sophisticated, and it's quite straightforward. Sometimes the investors are afraid of that, and they think that the loan is much simpler way to do. Instead of increasing share capital, but this is not actually always the case, and that's not always true because the legal procedure is not very complex. And yes, the last point: the share capital cannot be reduced if the equity would become negative as a result of such reduction. Next, let's see at the loan, and as I already said, the loan is much more simple way to finance a company. You just need an agreement, and it is recommended that the agreement is in a written form. It doesn't. Sometimes investors forget about that. They think that it's just sufficient to issue a loan, just to make a bank transfer, and that's it. But the Corporate Income Tax Act explicitly says that the loan should be in written form. So this means that we always recommend that you have the agreement in writing, And if you don't have the agreement, then probably it's sufficient to make some kind of deed or some kind of document where the parties have agreed that the amount transferred is considered a loan. That it's a loan payment, not something else. Because if the investor just simply transfers some funds to its subsidiary without any kind of substantiation, then there is a question: what is it? Probably it's payment for something, and it could be qualified as a revenue. So that's why it's always recommended to have this written agreement. And even if you have frequent payments, and you can make some umbrella agreement and then execute some deed for each payment of the loan. Okay, so written form. The next advantage is the funding and repayment is quite straightforward if the company has cash. But then comes the not so good things. And first of all is that there are some restrictions for loan financing. And the first restriction is the so-called thin capitalization, which means that in Latvian law that debt to equity ratio should not exceed 4:1. So if the share capital is 1, the maximum loan financing is 4. Yes. So if the loan financing is higher, ratio is higher, then part of the interest becomes taxable with corporate income tax. Yes, as I said before, the interest expense is not deductible for Latvian company, but if there is this thin capitalization rules are not observed, then this means that part of the interest becomes taxable in Latvia with corporate income tax, and we will see the example later. Next restriction, or not a pleasant thing, is transfer pricing. So interest expense which Latvian company pays to its shareholder is subject to transfer pricing rules. So it should be correspond to market ratio. And yes, these are two tax implications which are not very pleasant and which should be observed any time you issue a loan, any time the shareholder issues a loan to its subsidiary. For the loan, actually, there are also other restrictions that the granting a loan itself could become taxable event, but in case if the parent is granting a loan to subsidiary, this loan is not considered as a taxable event. So we will not go into detail and will not look at more detail in this video. But what you should remember that interest expense should not be more than its market value, and loan itself should follow this thin capitalization rules. What is good about loan financing and what we can see in the practice, which happens quite frequently, that the loan could be converted into share capital if there is such a necessity. For example, if to improve this thin capitalization issue, if the shareholder sees that the loan ratio is too high and the loan couldn't be repaid to the parent, then it makes sense to make a capitalization and increase share capital by this amount of the loan. So that's also legal procedure which should be also reported and submitted to the enterprise registry. But in essence, it's quite simple and requires a simple evaluator's assessment of this loan. But it's very, very simple. So what we can see in practice, and also if you're not sure about whether to issue a loan or equity, then probably it makes sense to start with the loan. And if you see that the company needs more funds and the loan ratio becomes too high, and you have to pay corporate income tax on this not allowable interest as a result of thin capitalization, then it makes sense to capitalize a part or partly or fully this loan. Now let's talk in more detail about the tax implications which are relevant for the loan. First of all, it's transfer pricing. For the borrower, interest rate should always do not exceed the arm's length or the market price of the comparable interest rate. What does that mean? It means that the interest rate should be the same as independent companies would apply in comparable circumstances, in comparable situation, in comparable manner. It sounds quite simple, but in practice you will never have information about interest rates which are applied between company-to-company loans. Yes, the only information you can get is from the Bank of Latvia, statistics about the loans applicable from the financial institutions to companies. Yes, but in practice, such approach is allowed by tax authority and is accepted, and it works in practice. The other approach is more complex and expensive, and this approach is in two steps. The first step is that the credit rating of the borrower should be established, and in the second step, the appropriate interest rate, which is relevant for this credit rating, should be searched for in specialized databases like Bloomberg, Loan Connector, and so on. So usually the second approach is applied when there are very high risks. Consider, for example, if the amount of the loan amounts to tens of millions or hundreds of millions, then it makes sense to make such a profound and complex and also an expensive study. In all that other situations, when the loans are, for example, few hundred thousand euros or even a million euros, then I would say that the use of the statistics is sufficient. Of course, it always, as we always recommend, is that the company apply a reasonable interest rate, and this interest rate usually is attached to Euribor or some other base rate set by the banks, and if you, for example, if the rate is Euribor plus 3 or 4%, then it makes sense that this interest rate is at arm's length. So two approaches for assessing the interest rates arm's length. One more thing which is important is that if the shareholder is individual, then individual shareholders are usually not subject to transfer pricing. As if we compare with a company, for example, but we are now talking about interest expenses, but for the lender, the interest should not be less than market rate, but should be at least at market rate or even higher market rate. But this relates to companies. So if the shareholder is a company, then it should seek some balance between the requirements in the shareholder's country and the operating company's country. So the tax authority of the shareholders company will expect that the interest rate is higher, and vice versa. In Latvian tax authority will expect that the interest rate is lower. So that's why there should be a balance between those two countries, and this balance is usually reached by attaching this rate to some base rate plus adding some premium, as like Euribor plus 2, plus 3, or even 4%. So it depends on the situation. But the case is, but the situation is different if the shareholder is not a company, but it's an individual. And individual shareholders are usually not subject to transfer pricing, that therefore since they are they're interested in funding their business, they usually and sometimes issue loans without interest, so interest-free. And of course, from the operating company's perspective, payment interest-free loan is absolutely acceptable, and the Latvian tax authority will not ask to, to pay some interest if the loan is interest-free. So therefore, the loans from the individual shareholders usually are interest-free, and that works perfectly fine. The next is thin capitalization. As we talked before, debt to equity ratio should not exceed 4:1 ratio. To understand it in detail, let's see at the example. Suppose that the equity is 100,000 euros, and this means that loan should not exceed 4 times the 100,000 euros, should not exceed 400,000 euros. But in case if the actual loan is 500 euros, then excess is 100 euros. So how to calculate the interest rate, which is not part of the interest, which is not allowable and is taxable with corporate income tax? First of all, we take the allowable amount of the loan and divide it by actual amount, and we got this ratio, in this case 0.8, and this is the ratio which should be applicable to the total interest amount in order to find out the allowable interest, and the difference will be not allowable. So if the interest rate is 10%, calculate interest 50,000 euros, allowable interest will be 40,000 euros, or 50,000 multiplied by 0.8. And which means that the difference to 10,000 euros, this is not allowable interest, and for that the corporate income tax is payable. So, in addition to that, those interest expense is not allowable against some taxable income. Moreover, you should calculate pay tax on this interest expense if this ratio, thin capitalization ratio, is not observed. So this is the thing which should always also be remembered when you make the structure of the share capital. And what is also important to know that the average loan liability is calculated throughout the year, but the equity should be at the beginning of the year. So this means that you should, at the end of the current year, you should plan what will be the financing for the next year, and if the loans that you do not plan sufficiently well and loan exceeds this ratio, then it becomes quite difficult to fix the things. Yes. Okay, the next thing which I wanted to draw your attention to is to compare the loan financing and equity financing. And let's do it based on the exact example. So, in order to allow you to show the difference between what would be the cost of loan financing and equity financing from the tax perspective. Let's see the example. In this example, we have 100,000 euros financing for the 5 years. And this financing could be either via loan or via equity. And the investor requires 10% yield in both cases. In one case, in loan case, it's interest, and in equity case, it's dividends, which are payable at the end of the 5th year. And for interest, the same. Also, it's payable. Interest is accrued, but paid at the end of the 5th year. So, and in order to compare these two financing options, we have to understand what happens not only in Latvia but also in the country of investor, in this case in Sweden. And if we look at the interest loan financing, then the interest income is subject to 20% Swedish tax. And another point is that this 20% tax is payable regardless whether interest is actually paid or interest is just accrued in the books of the investor. So compared with that, dividends are in Latvia is payable, the tax on dividends is payable only at the end of the 5th year. And during those 5-year period, no tax is payable for Latvia. And dividends received by Swedish investor, okay, I might be wrong, but I suppose that it's receiving or incoming dividends are not taxable in the hands of the investor. Let's assume that, and I'm quite sure that this is also in real life. So, yes, and to prepare those options, we should conclude that the repayment of the loan itself or equity itself has equal time effect. So it's repayable at the end of after 5 years. So it doesn't matter whether you repay a loan or you repay equity, like the use share capital. In both cases, that would be a repayment of 100,000 euros, and it will not attract any kind of tax consequences. But what is important that these two options, there are different tax implications, and the value of and the time value of the tax implications are different. Let's see them in the example. Okay, to compare both options, let's see at this table below. So we have at the first table we have a loan of 100,000 euros. For which Swedish investor receives, it doesn't receive, but it accrues interest each year. And the interest 10% per each year is 10,000 euros per each year. And out of this amount, regardless of whether it receives or not this interest, he has to pay tax in Sweden, 20% out of the interest income, and for each year. So each year, a Swedish investor pays 2,000 euros per interest accrued. And this is even in the case the interest is not actually received, it's just accrued in the books of Swedish investor. So this means that if we evaluate this as a project in a 5-year period, this means that the future payment stream has some present value. So if we apply 10% discount rate, we can calculate that the present value of the future payments, tax payments, is as follows. Yes, it reduces each year, but still the total present value of the future tax payments is 7,582. So this means that the project kind of tax value is this. But if we compare this equity, in equity case of equity, we had 100,000 euros before the project starts, and we do not pay any dividends, and therefore no tax is paid in year 1, 2, 3, and 4. And also in Sweden, the dividends, so there are no dividends, so no taxes payable anyway. But in the 5th year, we pay 50,000 euros as dividends and 10,000 euros as tax in Latvia. Yes. So this means that the present value of this tax payable in the 5th year is 6,209. So as you can see, the difference is quite considerable, and this means that it's about 20%, which means that in this case this project that financing with equity is by 20% more advantageous mathematically than the financing by the loan. And this is due to the special Latvian corporate income tax system. For example, of course, in the traditional corporate income tax system, systems it may not work like this. Most likely, it will not work. Will work like this. But in Latvia, in case of Latvia, as you can see, the equity financing is more advantageous. And this sometimes in practice is kind of not considered, because usually investors kind of try to finance everything as much as possible by the means of loan, because loan is more simple to administer, to repay, and so on. So yes, so that's the conclusion regarding the tax effect, and that yes. And if we take everything which we discussed together, then we can conclude that in theory, equities financing is more expensive. In theory, it should be considered as more expensive. And this is because it is considered that the investor requires higher yield than it has more risks and therefore higher yield for investing in equity. But in case of loan, that the loan is repayable in any way, so the risks are lower, so interest rate is lower as well. But in case if the investor has is the same person and there is a decision whether he invests in equity or loan, then this argument is not valid anymore. So, and that's why the equity and loan, the equity is not considered as more expensive, but in this case, even vice versa, more kind of less expensive than a loan. If we compare equity and loan from technical perspective, then loan is more simple to administer and more simple to repay, and so more elastic, but just a little bit, let's say, not very kind of just a little bit elastic, more elastic than equity, except the case when the things go wrong, and if a company has losses or equity is reducing due to losses, or then it may become difficult to repay the equity, to reduce the share capital. In this case, loan kind of is considered more reliable. But from the other hand, if the company has losses, it probably has cash flow problems, and it will probably have problems to repay a loan anyway. So that's why it's not a kind of very important argument. Of course, if and this is also from the theory, more that if it's decided to attract the financing by equity financing, then at some point investor may seek for the funds in external environment and attract some other shareholders, and in that case dilute his investment share structure. So from that perspective, of course, and this is also from the theory that the loan, and also from practice, that loan is more has less risks, that the minority shareholders can take control or has their own demands or something. So yes, and this is regarding equity. Regarding the loan, of course, it's easier to administer, easier to issue and repay, but it has those adverse capitalization and transfer pricing tax implications. And yes, then which may trigger tax consequences without even prior any profit is generated. And the good thing about the loan is that it could be capitalized to improve balance sheet and stop the accrual of interest expenses or income. So as a result, what we can see in practice, of course, most of the companies try to keep the equity level as low as possible, sometimes using minimum share capital. This is 2,800 and the rest financed by the loan. But from the other hand, in doing so, they are encountering those adverse tax implications. And then sooner or later they come to the point and they start to think about the capitalizing of the loan or repayment of the loan. But yeah, so therefore my recommendation is that is to consider to forecast requested funds in at least for 1 year ahead, and then to plan the ratio between equity and loan financing in order to be in line with thin capitalization ratio requirements, and also to apply, if it is decided to apply some interest rate by shareholder for the loans, then of course the recommendation is to apply some common sense interest rate, which could satisfy the both operating companies, country, in this case Latvia, and also investor country. So that's it for this video. That's it for today. If you have any questions, I would encourage you to contact me directly, or send us an email, or make a call. So we would be happy to assist you with any tax matters you may encounter in Latvia. So thank you for watching this video, and goodbye.